We see the core major markets in Europe already pretty strong, back close to their peak values in 2007, which is becoming a bit of a worry. And we see a bit more growth over the next 18 months before values start to come off the boil. At the moment, we've got a relatively modest correction in values, maybe 10% or so. But if leverage were to really join the party, then you could get something much more like 2007-8. So danger signs from 16 through to 18, really. We've certainly seen in this first phase of the recovery, if you can call it that, capital very much focusing on both the core countries and their major cities, and that's been a pretty diverse set of investors who are focused on those. With pricing there, they're becoming so aggressive, and with the periphery seeming to recover now economically, then you're seeing capital make its way pretty swiftly out from those central four big cities towards some of either the smaller provincial markets or alternative sectors, or indeed the peripheral economies. The bond markets seem to be pricing in steady increases in the bond yield over the next 4 or 5 years, maybe 25 bips per annum, something of that nature. And so we're seeing a gradual tightening of the screw on both the UK and the major continental markets. So good returns for property over the next 18 months or so, but then a slowdown as the bond yields tighten on the property yields. We see quite a strong bounce coming through in those southern European markets over the next 12 to 18 months, and they'll catch up a lot of their lost ground with the core type markets, and then you should be back into a more balanced type of situation.